Okay, so the last little lecture for this chapter is I've got two windows open. Okay, so what I'm going to be doing is kind of walking you through the material on the right-hand side and using the material on the left-hand side to help explain where it comes from. This is always hard, even in a face-to-face class, when you've got the slide in the front of the room, but it's referring back to something from previous slides, so this should work okay. So what we want to do right now, we've recorded all these transactions, and we have ending balances in all of these accounts, right? We've got assets and liabilities, and then we've got this equity account, retained earnings. And what we need to do is take this and turn it into financial statements, right? And so that's where we're going to be going with this. And I want to note that we're going to be doing what's called a classified balance sheet. And what that means is we separate out assets and liabilities based on how long they're going to last. Okay, so that's sort of like adding a little extra twist in this chapter. So that's where we're going with this. Okay, so here we are. What I've got here is I've got these transactions starting from the beginning, from the last lecture. I've got all these transactions, and we're going to try to track, as we're going through these again, we're going to track out where they show up over here on the income statement and the balance sheet, right? So right here, right, we received $1,800 as rent for 5 months worth, but nothing has been earned yet. Right, so this rent was prepaid. It's unearned revenue. Right, it's prepaid by the customer. It's unearned revenue, so it does not show up on the income statement. Right, there's nothing here, over here. Okay. Likewise, right, we paid 2 years worth of insurance for general business insurance for $2,400. Okay, this has not yet been actually incurred. We haven't operated during the month of November yet. So all it is we just purchased an asset. We purchased some prepaid insurance, but we haven't actually recognized it as an expense yet. Right, so you're not going to see it over here, not going to see this transaction for $2,400 over here. What you see in the insurance expense comes along later after we do our adjustments. Same thing with the malpractice insurance, right? That's not showing up in the income statement yet. Okay, she put more money into the business. Again, that's got nothing to do with the income statement. She's just injecting more capital into the business. And then she purchased some supplies, and she did not pay cash for those supplies, right? So she took on an accounts payable, which is a liability, and she purchased some supplies, which are an asset. Okay, this is a little complicated. Okay, we have $8,500 worth of office equipment. We took on a notes payable for a portion of it, and we paid cash for a portion of it. Again, when you buy equipment, that you can't expense that all right away. Okay, you have to hold on to it as an asset and expense portions of it in the form of depreciation. So again, this transaction does not show up over here on this income statement yet. Now, we earned fees of $6,100. Even though we haven't gotten any cash from that earnings yet, okay, we have to recognize the fees, and that's part of what shows up over here as this $12,350. And then we also took in some cash for our fees. Right, so we add those two together, and again, that shows up as part of this $12,350. So we have some that we billed, some that we got cash for, And then if I'm remembering right, there was another transaction where we haven't even issued the bills yet. Now, we paid part of our bills, right? We reduced our accounts payable by $100 because we paid our bill, but that is not a operating expense either. That's just a negative cash flow associated with running the business. But we did pay all of these expenses in cash. So here they go. We have wages expense of $27.90, but remember we had to make an adjustment for wages earned but not paid yet. So that's not the same as this over here yet. But we had rent expense of $800, we had utilities expense of $580, interest expense of $100, and miscellaneous expenses of $420. So most of these show up right over here on this income statement, except that we remember that wages have to be adjusted for the work that the employees have done but not yet been paid for. Okay, she paid herself $1,200. That does not show up on the income statement because dividends come out, they reduce retained earnings, but they aren't part of what you are reporting as income or expenses for the business. Okay, so here come all those adjustments. So, during the month of November, remember we had two different types of insurance. We had malpractice insurance and general business insurance. And $1,100 worth of those two types of insurance were used up over the course of the month of November. So we recognize insurance expense over here as $1,100. And it shows up in this model as reducing our retained earnings. We used up $150 worth of the supplies, even though we paid for them earlier in the month. We used them up, so we're left with $90 worth of supplies. So here's that supplies expense showing up over here in our income statement. Here's our depreciation expense that we recognize from the office equipment. Right, so we take $160 worth of depreciation on our office equipment, and that shows up over here on the income statement. And then we also recognize that from that $1,800 in unearned revenue for the prepayment of rent for 5 months, the first transaction on the list, we take 1/5 of that as the actual revenue that is earned from the rental of that parking lot. And then we take and we recognize the wages that people have earned but not been paid. Even though we haven't paid them yet, we recognize those as a portion of the wage expense above and beyond that cash that we paid for wages that we already saw. And then the last thing is that we had $750 worth of fees that haven't even been billed yet, but that we do have to recognize, bringing the grand total up here to $12,350. And so that's how you connect what's going on with all of these adjustments and prepayments and whatnot to the income statement. Now the next thing we look at is the statement of retained earnings, or the statement of stockholders' equity. Okay. So we started our month with $6,000 in common stock that she had originally invested in the company. And then if you remember, she put in $5,000 more. So that means that we have $11,000 at this point in stock. Okay, we have $8,510 net in retained earnings, which takes into account the $1,200 in dividends that she paid herself, which gives us a total stockholders' equity balance of $19,510. Okay, so this is our statement of stockholders' equity or retained earnings for the month. And that leads us into the balance sheet. Now we have everything we need for our balance sheet. So you will notice that our assets are now broken out into current assets and fixed assets. And our liabilities likewise are broken out into current liabilities and long-term liabilities. And there's a lot of good reasons for this, which we're not going to go into in this class. If you want to take more accounting classes, though, I know just where you can. So we have current assets of $17,700, which consist of cash. And you see how it connects over here to our ending balance after all these transactions? Cash of $77.30, accounts receivable of $26.50. You see? Prepaid insurance of $7,300. It all just comes right off the bottom of these transaction records that we've been doing. Supplies of $90. These are our current assets. Current assets, what that means is that they are going to turn into cash. They can quickly be turned into cash. So we assume that our accounts receivable, which are the monies that we are owed by our customers, are going to be paid, that our prepaid insurance is going to be used up, and that our supplies are going to be used up. So these are current assets. And then our fixed assets are things that are not going to be used up within a year. So that would be office equipment, which we expect to last longer than a year. We take out the accumulated depreciation, giving us a net value of our office equipment of $83.40. We have $12,000 worth of land, so our total fixed assets are $20,340, giving us a total assets of $38,110. Now on the liabilities side, right, we have our accounts payable of $140. Our wages payable, remember that was the wages that have been earned and not yet paid. Notes payable of $6,800. Now they break out current liabilities from long-term liabilities. And if you remember from last time, she took out a $10,000 long-term loan. Right, so that's a long-term loan. That shows up as a long-term note payable. But she also borrowed $6,800 for, gosh, I can't remember, maybe for the office equipment. Right, so that she's going to need to pay pretty quick. Right, and so that shows up in the short-term or the current liabilities. And then she's got unearned revenue totaling $1,440 from that rent payment, 6 months worth of rent, right, giving the total liabilities of $18,600. And then there's $11,000 of stock, $8,500 of retained earnings, giving a total equity account of $19,510, and our balance sheet balances, which is always a good thing. Right? So that's where the balance sheet and the income statement come from all these transactions. You take the ending balances in these accounts for the balance sheet, keeping track of which of your liabilities are short-term and long-term. And you track the income statement accounts sort of as they're going on, so that you can make sure everything adds up right. And so that's how you make your financial statements from these. Now, in the practice problems, right, I'm going to show you how specifically to do this with a real, an actual example from the Cengage homework or from the Cengage practice problems. So you will be able to do this yourself. It's really hard to really grasp it from just watching a lecture. So you're going to have to do the practice and do it yourself and get your head around it. So that, my friends, was chapter 3.